Hello, investors. We are commencing the Q1 2026 shareholder letter. This letter will be used to share Duolingo's performance from the past quarter and our plans for the future. The screen currently displays the title Shareholder Letter Q1 2026 for Duolingo. This information will serve as a crucial foundational basis for understanding the overall context of what we will discuss going forward. Our mission is to develop the best education in the world and make it universally available. This statement goes beyond a simple slogan, clearly outlining the core values this company pursues as an education content provider. The goal of the best education will be achieved through qualitative excellence and innovative teaching methods, while making it universally available emphasizes accessibility and inclusivity. This, in turn, suggests positive market outlooks for the growth potential of the education sector and the expansion of educational opportunities through technological advancements. Such a vision can offer attractive investment opportunities to potential investors, encompassing both long-term growth and social contribution. Let's first look at the Q1 highlights. Daily active users increased from 46.6 million in Q1 2025 to 56.5 million in Q1 2026, representing a 21% year-over-year growth. This indicates a robust expansion of the user base. Furthermore, paid subscribers at period end grew from 10.3 million in Q1 2025 to 12.5 million in Q1 2026, also a 21% year-over-year increase. The fact that both user numbers and paid subscribers grew at the same rate suggests a high conversion rate of new users to paid services or a low churn rate among existing paid subscribers, positively forecasting the company's sustained growth potential. This table compares key financial metrics for Q1 2025 and Q1 2026. Revenue increased by 27% from $230.7 million in Q1 2025 to $292.0 million in Q1 2026, indicating a very positive growth trend. Total bookings also grew by 14%, rising from $271.6 million to $308.5 million. Net income climbed from $35.1 million to $43.5 million, and while the net income margin slightly decreased from 15.2% to 14.9%, it remains robust. Adjusted EBITDA saw a significant increase from $62.8 million to $83.4 million, with its margin improving from 27.2% to 28.6%. Net cash provided by operating activities surged substantially to $150.8 million from $105.6 million, demonstrating strong cash generation capabilities with an impressive 51.6% margin. Finally, free cash flow grew to $147.8 million from $103.0 million, also maintaining a high margin of 50.6%. Overall, the company exhibits remarkable growth across all key metrics, with the significant increases in operating cash flow and free cash flow strongly supporting its financial health and growth potential. In Q1, we executed the strategy outlined in our last shareholder letter. It's still early to gauge the full impact on our metrics, but our results so far are in line with expectations. As a reminder, our medium-term goal is to reach 100 million daily active users by 2028. We believe this will make Duolingo a significantly more valuable company, so we are prioritizing both learning outcome improvements and user base growth. In this letter, we will share more about the work we are doing to enhance learning outcomes. Notably, speaking practice, historically the biggest gap for learners on Duolingo, is now a core part of the product. For paid subscribers, video call continues to improve and remains one of our most impactful features. Over the last year, we've more than doubled the average number of words spoken per user in video call. This has been enabled by features like spoken tokens, which allow learners to speak their answers to most exercises instead of tapping the words. This is an important change that enables almost every exercise in Duolingo to become a speaking practice. Additionally, Flashcards help learners build fast recall of words or phrases by saying them out loud, which is critical for developing conversational skills. Lastly, speaking adventures prepare learners for conversations by having them complete real-world tasks with our characters. These scenarios come from the course curriculum, reinforcing the concepts users are learning. These three screens demonstrate Duolingo's diverse learning methods. The leftmost screen features spoken tokens, where users listen to a sentence and select word tokens in the correct order to construct it. The middle screen showcases flashcards, focusing on fundamental vocabulary acquisition through activities like matching words to their meanings or listening and repeating. Finally, the rightmost screen presents speaking adventures, offering an immersive experience where users interact with characters in a virtual environment, simulating real-life conversations. This illustrates how Duolingo goes beyond simple memorization, maximizing learning effectiveness by supporting contextual language application and practical speaking practice. This chart illustrates the expansion of learning content offered by Duolingo across Q1 2024 and Q1 2026. The left side shows the status as of Q1 2024, with green dots indicating the availability of learning content for each of the 9 most learned languages, categorized by CEFR levels, A1 to B2. An X signifies that content for that level is not provided. For instance, English learners can see that content is well established up to B1 and B2 levels for languages like French, German, and Spanish, but only up to A2 level for learners of Japanese or Chinese. The right side displays the plans up to Q1 2026, confirming that content has been completed up to the B2 level for most language pairs. Notably, many more green dots appear compared to Q1 2024, indicating that Duolingo has significantly expanded its learning content to enable users to achieve professional proficiency in languages. This content expansion supports learners in reaching higher levels of language competence and is interpreted as a key strategy to strengthen Duolingo's educational impact. We have achieved significant improvements in content creation speed through our investment in AI tools. In Q1 of 2026 alone, we published 20,500 course units, which are collections of lessons teaching vocabulary and grammar topics across our language courses. This marks a substantial increase from 7,100 units per quarter in 2025 and 1,800 units per quarter in 2024. Automating our content creation process allows us to iterate in ways previously not possible, enabling us to push changes across multiple courses simultaneously and improve quality more rapidly and consistently. These enhancements are already leading to improved engagement among new users. Furthermore, we have focused on enhancing our Chinese, Japanese, and Korean courses. While these are among our most popular offerings, they can be perceived as challenging due to their character writing systems. We are making these courses more approachable by simplifying early lessons and easing the learning process for characters. To ensure learners truly master the material, we have introduced a mastery assessment session at the end of each content unit. This approach prevents users from progressing until they have successfully mastered the preceding concepts, which is crucial for effective learning outcomes. Equally important, this provides us with valuable data on the effectiveness of each content unit, enabling us to further refine and improve the quality of our instruction. In conclusion, while Duolingo is in the early stages of its strategic shift, its performance is already exceeding expectations. Specifically, speaking practice has become a core feature, intermediate and advanced level courses have been expanded, and features are being developed to ensure learners master concepts before progressing. These initiatives are crucial for achieving long-term goals, and an improved learning experience will ultimately drive customer engagement, retention, growth, and brand credibility. The company is prioritizing its product and free user experience while also investing in new growth engines like chess, math, and music. We are confident that these efforts will ultimately make Duolingo a larger and more robust company. Furthermore, from a long-term perspective, the company has repurchased over 500,000 shares since its last earnings call, representing more than 100% of 2025 dilution. We are energized by what lies ahead and grateful to all our investors for believing in our mission. This slide presents a summary of the company's financial and key operating metrics, compared to the previous period. Looking at user metrics, daily active users, DAUs, increased by 21% from 46.6 million to 56.5 million, and paid subscribers grew by 21% from 10.3 million to 12.5 million. This indicates robust growth in the user base. Under operating metrics, subscription bookings rose by 15% to $268.1 million from $232.2 million, and total bookings increased by 14% to $308.5 million from $271.6 million. Examining GAAP financial measures, revenues saw a significant 27% jump to $292.0 million from $230.7 million, while gross profit grew by 30% to $213.1 million from $164.1 million. The gross margin improved by 190 basis points to 73% from 71.1%. Net income grew by 24% to $43.5 million from $35.1 million, and net cash from operating activities surged by 43% to $150.8 million from $105.6 million. Under non-GAAP financial measures, adjusted EBITDA increased by 33% to $83.4 million from $62.8 million, with the adjusted EBITDA margin expanding by 140 basis points to 28.6% from 27.2%. Free cash flow also saw a substantial 43% increase to $147.8 million from $103.0 million, and the free cash flow margin improved significantly by 600 basis points to 50.6% from 44.6%. Overall, these metrics demonstrate very strong growth for the company, not only in expanding its user base but also in revenue, profitability, and cash flow generation. Let's review the first quarter 2026 highlights. First, daily active users, DAUs, reached 56.5 million, a 21% year-over-year increase, marking a solid start to the year. Although this growth rate is lower than the 49% growth in Q1 2025, total bookings for the quarter grew 14% year-over-year to $308.5 million, benefiting from our Dead Duo campaign. This growth was driven by subscriber expansion and favorable advertising trends, leading to revenue growth of 27% year-over-year, or 22% on a constant currency basis, reaching $292.0 million. The gross margin expanded by 190 basis points to 73%, primarily due to continued reductions in per-unit AI costs. We generated $43.5 million in net income and $83.4 million in adjusted EBITDA, with the adjusted EBITDA margin increasing by 140 basis points year-over-year to 28.6%. As of the end of the quarter, we had $1.1 billion in cash and cash equivalents. Net cash from operating activities for the quarter was $150.8 million, and free cash flow, FCF, was $147.8 million, representing a 50.6% FCF margin. The weighted average diluted shares outstanding ended the quarter at approximately 49.7 million. Furthermore, we remain committed to managing dilution while retaining the financial flexibility to invest in our long-term growth priorities. Since initiating our $400 million repurchase program in February, we have repurchased approximately $50.6 million, or roughly 514,000 shares, through May 1, 2026. This represents more than 100% of our 2025 net dilution from equity awards. This slide details the guidance for Q2 and the full year of 2026. The company's strategic plan for 2026 remains unchanged, and they are continuing to manage the business towards the full-year targets previously outlined. These targets encompass a bookings growth of 10 to 12%, revenue growth of 15 to 18%, and an adjusted EBITDA margin of 25%. The updated guidance reflects actuals from Q1 and the current outlook for the second quarter ending June 30, 2026, and the full year ending December 31, 2026. The figures are in millions of dollars. For Q2 2026, bookings are projected at $283.5 million, representing a year-over-year growth of 5.8%. The full year 2026 bookings are expected to reach $1,280 million, with a year-over-year growth target of 10.5%. Projected revenue for Q2 2026 stands at $295.5 million, an increase of 17.1% compared to the previous year. Full-year revenue is anticipated to be $1,205 million, targeting a 16.1% year-over-year growth rate. Adjusted EBITDA is forecasted at $71.0 million for Q2 and $310 million for the full year, with adjusted EBITDA margins projected at 24% for Q2 and 25.7% for the full year. This guidance clearly illustrates the company's growth trajectory and profitability objectives. For fiscal year 2026, we anticipate bookings to grow by approximately 10.5% year-over-year, with Q2 growth projected at 5.8%, 8.6%, and 4.1% respectively on a constant currency basis. While Q2 faces a challenging bookings growth comparison, we expect bookings growth to accelerate through the remainder of the year. Revenue is expected to grow by approximately 16.1% year-over-year in fiscal year 2026, with Q2 growth at approximately 17.1%, 14.5%, and 15.8% on a constant currency basis, respectively. Growth is expected to moderate in the latter half of the year. We expect a gross margin of approximately 71% in Q2. We believe this gross margin will trend down to approximately 69% by Q4 as the expanded use of AI features in our products takes hold. For the full year, we project an adjusted EBITDA of $310.0 million, representing an approximate 25.7% margin. For Q2, we anticipate an adjusted EBITDA margin of around 24%, and we believe this margin will be flat to slightly down in Q3 before rising again in Q4. Stock-based compensation in 2026 is expected to be nearly 15% of revenue. This is driven by equity grants aimed at attracting and retaining talent, leading to an approximate 3.5 to 4% increase in the fully diluted share count for the year, even as absolute expense levels grow. This projection excludes the impact of any buyback activity. Buyback activity through May 1 accounts for approximately 1% of fully diluted shares outstanding. We currently believe it is reasonable to assume an effective tax provision of approximately 18 to 20% for 2026. This table outlines Duolingo's outstanding dilutive securities. As of March 31, 2026, the share price stands at $98.57, with 46.9 million common shares outstanding. Additionally, there are 0.8 million in founder awards, 0.5 million in stock options, and 1.5 million in RSUs outstanding. Notably, the weighted average exercise price for stock options is $20.71, a figure significantly lower than the current share price. If all these dilutive securities were exercised, the total estimated diluted shares outstanding would increase to 49.7 million, a critical factor that could impact earnings per share. This balance sheet summarizes the assets as of December 31, 2025, and March 31, 2026, in thousands of dollars. Looking at current assets first, cash and cash equivalents increased from $1,036.389 billion to $1,138.561 billion, a rise of approximately $102.172 billion. Short-term investments also grew from $104.078 billion to $113.049 billion. Accounts receivable decreased from $162.827 billion to $125.086 billion, which could indicate improved collections or a decline in sales. Deferred revenue increased slightly from $102.663 billion to $104.513 billion, and income tax receivable significantly decreased from $14.067 billion to $5.092 billion. Prepaid expenses and other current assets rose from $16.582 billion to $19.658 billion. Consequently, total current assets increased by approximately $69.353 billion, from $1,436.606 billion to $1,505.959 billion. Moving to non-current assets, operating lease right-of-use assets saw a slight decrease from $80.380 billion to $79.944 billion. Long-term investments increased from $135.098 billion to $140.211 billion. Net intangible assets remained unchanged at $28.309 billion. Net property and equipment increased slightly from $36.297 billion to $36.966 billion, while goodwill stayed constant at $35.335 billion. Restricted cash remained at $2.735 billion, and net deferred tax assets decreased from $227.339 billion to $217.837 billion. Other assets saw a minor increase from $10.083 billion to $10.680 billion. Overall, total assets grew by approximately $65.812 billion, from $1,992.182 billion to $2,057.994 billion. These changes in asset composition are key indicators of the company's investment activities and operational efficiency. Let's analyze Duolingo's balance sheet, comparing its assets, liabilities, and equity structure. First, examining current liabilities, they increased from $551.148 million as of December 31, 2025, to $574.114 million as of March 31, 2026, representing a rise of approximately 4.17%. Notably, deferred revenues, which constitute a significant portion, grew from $496.205 million to $513.256 million. This indicates an increase in revenue received in advance from customers, suggesting higher potential future revenue recognition. Additionally, accrued expenses and other current liabilities also rose from $45.688 million to $49.558 million, contributing to the overall increase in current liabilities. Total liabilities climbed from $645.176 million to $666.230 million, an increase of about 3.26%. Moving on to the equity section, we see details related to preferred and common stock. Interestingly, treasury stock, which was zero at the end of 2025, shows that 4,499 shares were repurchased by March 31, 2026. This can be interpreted as a move to enhance shareholder value through share buybacks. Additional paid-in capital saw a slight increase from $1,058.783 million to $1,064.580 million, while retained earnings grew by approximately 15% from $288.218 million to $331.678 million, demonstrating a robust growth trend. Consequently, total stockholders' equity increased from $1,347.006 million to $1,391.764 million. Overall, while Duolingo's liabilities have seen a slight increase, the company is strengthening its financial structure by expanding its equity base, driven by growth in retained earnings. The income statement you are currently viewing compares Duolingo's performance for the 3 months ended March 31, 2025, and the 3 months ended March 31, 2026. Notably, revenue saw a significant increase from approximately $230 million in 2025 to about $291 million in 2026, representing a growth rate of around 26.7%, which is a positive indicator. While the cost of revenue also increased, the revenue growth rate was higher, leading to a gross profit increase of approximately 29.9%, from about $164 million in 2025 to $213 million in 2026. In terms of operating expenses, both research and development and sales and marketing saw increases, with total operating expenses rising by about 19.6% from approximately $140 million in 2025 to $168 million in 2026. Despite this rise in operating costs, driven by substantial revenue growth, operating income more than doubled, increasing from approximately $23 million in 2025 to $44 million in 2026. Net income also showed a significant improvement, rising from about $35 million in 2025 to $43 million in 2026. This improvement is reflected in the earnings per share, EPS, as well, with basic EPS increasing from 78 cents to 93 cents, and diluted EPS rising from 72 cents to 89 cents. Overall, we can confirm that Duolingo is achieving profitability improvements alongside revenue growth. Let's examine Duolingo's cash flow statements for 2025 and 2026. First, cash flow from operating activities saw a significant increase, rising from $105,631,000 in 2025 to $150,771,000 in 2026. This growth is attributable not only to an increase in net income from $35,135,000 to $43,460,000, but also to positive contributions from non-cash expenses like depreciation and amortization, stock-based compensation expenses, and favorable changes in assets and liabilities. Cash flow used for investing activities increased in outflow, moving from a negative $10,549,000 in 2025 to a negative $16,749,000 in 2026, suggesting the company is investing more capital in its long-term growth. Cash flow from financing activities shifted from an inflow of $3,123,000 in 2025 to an outflow of $31,850,000 in 2026. Considering these activities overall, the company's cash and cash equivalents at the end of 2026 increased substantially to $1,141,296,000 compared to the previous year, demonstrating a positive trend where cash generated from robust operating activities flowed through investments to ultimately increase cash holdings. This table presents the revenue breakdown by product type. Total revenue in Q1 2025 was $230.74 million, growing to $291.97 million in Q1 2026, an increase of $61.22 million, or 27%. Notably, subscription revenue surged by $59.92 million, a 31% increase, driving overall growth. Advertising revenue also showed positive momentum, rising by $2.73 million, or 15%. However, revenue from the Duolingo English test experienced a decline of $6.69 million, a 6% decrease, and in-app purchases also saw a downturn, falling by $9.96 million, or 11%. The other category saw a modest increase of $2.36 million, representing a 53% growth. Overall, the strong performance in subscription services is offsetting declines in other segments, propelling the company's total revenue growth. This slide compares the financial performance for the 3 months ended March 31, 2025 and 2026. Starting with net income, it increased significantly from $35.135 million in 2025 to $43.460 million in 2026, showing approximately 23.7% growth. Interest income decreased from $10.415 million in 2025 to $11.811 million in 2026, while the benefit from income taxes increased from a negative $0.125 million in 2025 to $12.092 million in 2026. Depreciation and amortization rose from $3.590 million in 2025 to $4.191 million in 2026. Stock-based compensation expenses increased slightly from $34.519 million in 2025 to $35.155 million in 2026, and acquisition earnout costs increased from $0.100 million to $0.345 million. Adjusting for these items, adjusted EBITDA showed substantial growth of 32.8%, from $62.804 million in 2025 to $83.432 million in 2026. Furthermore, revenues grew by 29.3%, from $230.743 million in 2025 to $291.967 million in 2026. Consequently, the adjusted EBITDA margin improved from 27.2% in 2025 to 28.6% in 2026, indicating an enhancement in the company's profitability. Next, let's look at the reconciliation from GAAP operating expenses to non-GAAP operating expenses. Total GAAP operating expense increased from $140.502 million in 2025 to $168.569 million in 2026. Deducting depreciation and amortization, stock-based compensation expenses, and other adjustments yields non-GAAP operating expense. Non-GAAP operating expense, which was $104.524 million in 2025, grew to $131.675 million in 2026, a 26% increase. This financial performance clearly demonstrates the company's robust growth trajectory, and the significant rise in adjusted EBITDA along with the improved margin can be interpreted as positive signals for investors. This slide details the reconciliation of expenses between GAAP and non-GAAP standards. Let's first examine the research and development (R&D) expenses. For the 3 months ended March 31, 2025, total GAAP R&D expense was $70.39 million, which increased to $82.97 million for the same period in 2026. This figure excludes depreciation, amortization, and stock-based compensation expenses, with a notable rise in stock-based compensation costs. Selling and marketing (S&M) expenses also saw a significant increase, from $26.66 million in the 3 months ended March 31, 2025, to $39.24 million in the corresponding period of 2026. The non-GAAP S&M expense, after adjusting for stock-based compensation, rose from $24.93 million to $37.27 million. Finally, looking at general and administrative (G&A) expenses, they increased slightly from $43.45 million for the 3 months ended March 31, 2025, to $46.34 million in the same period of 2026. Here too, the non-GAAP G&A expense, excluding stock-based compensation and other adjustments, grew from $28.92 million to $35.11 million. Overall, there is a clear upward trend in R&D and S&M expenses, with stock-based compensation costs constituting a substantial portion. This slide reconciles free cash flow and free cash flow margin. For the 3 months ended March 31, 2025, net cash provided by operating activities was $105,631,000, and this figure substantially increased to $150,771,000 in the same period of 2026, representing an approximate 43% year-over-year growth. Notably, despite an increase in capital expenditures, including capitalized software development costs and purchases of intangible assets and property and equipment, from $2,619,000 in 2025 to $2,985,000 in 2026. Free cash flow grew from $103,000 and $12,000 in 2025 to $147,786,000 in 2026, also an increase of approximately 43%. Furthermore, as revenues grew by about 26% from $230,743,000 in 2025 to $291,967,000 in 2026. The free cash flow margin improved from 44.6% in 2025 to 50.6% in 2026. This increase in free cash flow suggests that the cash generated from the company's core operations is growing much faster than the cash used for investments and other activities, which can be interpreted as a very positive sign for financial health and future growth potential.